Well, thank you, Eddie, for that. That was very nice. And also thank the Wayne Economic Development Council for inviting me to speak on the economy and monetary policy in this Briefings for Business series. You know, when I think about what your council's work is about, it's to foster economic development in the region. And that really aligns very well with the Federal Reserve's mission to foster a strong economy. So I'm particularly happy to be here today. Now, as you know, Eddie Steiner is an active member of our board of directors. He's also the chair of our board's audit committee, and as he says, you know, this is important work that we do on behalf of the country, and we couldn't do it without board members like Eddie Steiner, so I really appreciate that. Steve Matthew is going to be moderating the Q&A portion of today's session, and he is an active member of our Northeast Ohio Business Advisory Council. And I really want to take the opportunity to thank both Steve and Eddie for all their contributions that they're making on behalf of our bank. We could not fulfill our mission without their help. And I also want to thank the many others in this room. You know, you all regularly provide us with economic information that's really crucial to our understanding of what's happening in the economy. And if you look at the Beige Book, which is the publication that the Federal Reserve publishes a couple of weeks before each Monetary Policy Committee meeting, you'll find that, you know, we summarize the information we've gleaned from our district in that book. And that really helps us understand what's going on in businesses, the labor market, communities, and financial markets, and it really is really important information. You know, we do get a lot of data. Everyone can gather economic data. The government puts out statistics. We gather our own data as well in some of our own surveys. But a lot of times that data tells you about where the economy is or where it's been. The information that we're getting from all our contacts throughout the district really tell us about a good idea of where the economy is going. It really helps us discern the future a little bit about where the economy, how it's evolving. So that's really important for monetary policy making. So the people who are providing us with information, and I want to thank the many people in this room and who are listening in for doing that work for us, you are playing an important role in the making of monetary policy. It really helps inform my own views about where the economy is going, the outlook for the economy, and what I should be doing as a monetary policymaker. And I bring that information with me to FOMC meetings, and I share it with other policymakers so they also can understand what we're seeing here in our region of the economy. So thank you very much for that. I really do appreciate that effort because you're all very busy in your own companies and your own businesses and your own communities, but you're doing this on behalf of the public, and I really appreciate that. So as Eddie said, I'm really looking forward to the Q&A portion of this speaking engagement. I really learn a lot from what I hear on people's minds. It does help inform my views on the economy. So I really do hope that you'll use the cards on your table to put in some questions, and I'll do my best to try to answer them and give you my views on those topics. But before we get into that portion and that dialogue, I thought it would be really helpful to frame the discussion by offering some remarks about the economy and monetary policy. And I must say, the views I present today will be my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So the FOMC met about 2 weeks ago, and at that meeting, the committee decided to maintain the target range for the federal funds rate, which is our policy rate, at 5.25% to 5.5%, and to continue to reduce the Federal Reserve security holdings. And we've held our policy rate at that restricted level since July of last year. Now, the FOMC reiterated that it doesn't expect it will be appropriate to reduce the target range until the committee has gained greater confidence that inflation is moving sustainably toward our goal of 2%. Now, if you step back, substantial progress has been made on the inflation front since inflation peaked in 2022. And remember, it peaked in a range of 7% to 9%, depending on the measure that one looked at. In the second half of last year, inflation readings came in lower than expected, and PCE inflation was running at about 2%, or at our 2% goal over those 6 months of the year. But the year-over-year measures of inflation remained elevated, and we on the FOMC knew it was too soon to declare victory over inflation. Now, over the first 3 months of this year, we have seen no further progress on PCE inflation. In fact, measured year-over-year headline PCE inflation moved up to 2.7% in March, and core PCE inflation remained at 2.8%. And if you look at the 3-month changes, they're running considerably above the levels seen over the second half of last year. Over the past 3 months, PCE inflation in core goods and PCE inflation in core services, excluding housing, have moved up, and housing services inflation has moved sideways. Now, we did get a CPI inflation report yesterday. That's the first inflation report we have for the month of April. And we saw a welcome tick down in the monthly readings for total and core CPI inflation, but those readings were higher than those we saw in the second half of last year. Now, I had expected the progress on inflation to slow this year compared to last year because I didn't think we'd get as much help from the supply side adjustments that we got last year. Supply chain disruptions and bottlenecks have really improved over the past 3 years, and the labor market has been normalizing. So people have returned to the labor force over time, and immigration has also increased the supply of labor. So that healing of the supply side of the economy contributed to last year's disinflation, and I don't think we're likely to get as much help on inflation from the supply side this year as we saw last year. Progress will depend more on moderating demand. Still, the lack of progress on inflation so far this year has been disappointing. I do think it's too early to conclude that progress on inflation has stalled out or that inflation is poised to reverse course. You know, we knew that the journey back to price stability was never going to follow a smooth path, but the recent readings have not inspired greater confidence in me, and we're going to just need to accumulate further data over the coming months to have a clearer picture of the inflation outlook. I now believe it's going to take longer to reach our 2% goal than I had previously thought, but, and I want to say this very emphatically, the Fed remains strongly committed to returning the economy to price stability. Now, the good news is that the economy is well positioned to allow us to accumulate those data without concern that monetary policy is overly restrictive. A really remarkable thing about last year's disinflation is that it occurred in the midst of strong economic growth and labor markets. Last year, the economy grew at a pace above 3%, which is higher than my 2% estimate of trend growth. And indicators point to continued upward underlying momentum in the economy this year. According to the advanced estimate, GDP growth did moderate to a 1.6% pace in the first quarter, but that step down reflected the inventory and trade components, and those components are often revised in subsequent releases as more data come in. If you look at final sales to private domestic purchases, so think about, that's a pretty good indicator of underlying demand, that continued to rise at a pace of around 3%. So that's pretty good growth. Consumer spending has remained healthy, although we have seen rising credit card delinquencies. And business fixed investment in equipment and software has strengthened, which is consistent with the anecdotal evidence that we're getting from our business contacts. Indeed, leading up to the FOMC meeting 2 weeks ago, there was a significant change in tone from the contacts in our district. Many reported that economic activity had strengthened, and by more than they had anticipated over that period. Labor market conditions also remain strong. Payroll job growth really has been remarkably resilient. Job gains averaged about 270,000 per month in the first quarter of this year, compared to 210,000 per month in the previous quarter. Now, we did see a moderation in employment last month, but it's still a healthy gain of 175,000 last month. The unemployment rate remains low. It's 3.9% as of April. And even with those strong numbers, we have seen some better balance coming into the labor market. You know, demand for workers is moderated, supply of workers has increased. And the gap between the number of open jobs and the number of unemployed workers has narrowed over time. In fact, it's now about 1.3, so 1.3 jobs per unemployed. And that's only slightly above the 1.2 level that we saw in 2019, which was also another period of strong labor market conditions. And when you talk to regional contacts, they tell us that it does remain difficult to find candidates with the skills needed for certain jobs. But in general, they also tell us that it has become easier to hire over time, and that's that moderation that we're looking for. Now, as labor demand has come into better balance with labor supply, wage pressures have eased. So firms in our district, right, are now expecting wage increases to average about 4% this year, but last year they were expecting them to be 5%. So that's a moderation. And if you look at the wage premium, right, what can you get from switching jobs compared to staying in your job, in your current job? That's moved back down to levels that are about where they were pre-pandemic. So another sign that there's been some, you know, better balance in the labor market. You know, that level had shot up during the pandemic, and right after the pandemic, when the labor markets were open again, the economy was open again, and people were really being bid away from their current jobs because firms just really needed to have workers. Now, the question always comes up like, well, is that wage growth inflationary or not? And, you know, whether wage growth adds to price pressures depends on whether wages are adjusted for inflation, so real wages, are growing faster than the growth in labor productivity. Now, if you look at current estimates of trend productivity growth, right, they're in the 1 to 1.5% range. So wage growth is still above the level consistent with 2% inflation at that level of trend productivity growth. But there is a possibility that changes in technology are going to lead to higher trend productivity growth. You know, if you think about the scarcity of workers during the pandemic, you know, we heard from many, many firms that, you know, they had this great incentive to automate and they were doing so. And then there's new technologies such as generative AI. I mean, they do hold the promise of increasing productivity over the medium to longer run. So if it's true that there's going to be higher productivity growth and that those high numbers that we got last year, if they're sustained, then it could be that current levels of wage growth could continue without adding to price pressures. However, if the estimates of productivity growth that we've had over time, the 1 to 1.5, then we'll still need to see some moderation in wage growth. Now, when you think about our regional economy, the current developments in activity, employment, and inflation at the national level, we're also seeing them in Ohio's economy. And, you know, as in the nation, labor market conditions in the state remain strong, but we have seen signs of them moderating, which is a good thing. The state's unemployment rate has ticked up this year, but it stands at 3.8% in March, and that just is it's near its historical low, so that's a strong indicator. Employment growth over the first 3 months of the year has slowed from last year's strong pace, and that's another sign of moderation, still healthy but moderating. And as I mentioned, employers in the state are telling us that it's now easier to hire than it was. Now, immigration has likely helped ease some of that labor market tightness. Last year, immigration was the main driver of an increase in Ohio's population, which was the first yearly rise in population since the pandemic. So all in all, we have seen strong labor market performance in the state, just as we've seen it at the national level. Now, Ohio is the 7th largest economy in the nation in terms of gross state product. Manufacturing and within manufacturing, auto and auto parts constitute an important sector of Ohio's economy. And compared to the nation, manufacturing still represents a larger share of payroll jobs in Ohio. But if you look over time, that differential has fallen as the economy here is diversified from one largely dependent on manufacturing and heavy industry to one in which healthcare and education play a more significant role. So if you think back to the 1990s, Manufacturing represented about 20% of Ohio's jobs, and eds and meds represented about 12%. Those shares have now basically reversed. In the past decade, the share of jobs in manufacturing has fallen to under 13%, and the share in eds and meds has risen to nearly 17%. So we see this transformation over time in our economy. Now, the good thing is that regions that have diversified their industrial base have generally fared better over time and have proven to be more resilient. When a shock hits the economy, they've been able to bounce back better than other regions that are more heavily in one industry or another. But of course, the type of shock that hits the economy matters for that, right? It can, that type of shock can have differential impacts on regions depending on what their industrial mix looks like. So, for example, if you think back to the pandemic, healthcare was hit particularly hard. And the labor market in healthcare remains particularly tight, with nurses expected to remain in short supply for some time to come. But the good news here is that even within healthcare, our contacts are reporting to us that they have seen some improvement in hiring and some normalizing in wage growth. So again, the trends we're seeing in the nation are being seen in our own regional economy as well. So what about the outlook? So in my view, the most likely scenario for the overall economy is that, and that of our region as well, is that the current restrictive stance of monetary policy will continue to help moderate growth in labor market conditions, and this moderation will contribute to further easing of price pressures. So I do expect progress on inflation over time, but at a slower pace than we saw last year. And there's some research that supports that view. Analysis at the Cleveland Fed indicates that if you look at the past slowdown in wage growth that we've seen, that's going to pass through to lower price inflation in core services, and that the declines that have occurred in rents in new leases will pass through to slower inflation in housing services. But both of those effects are going to be needed for us to get back to 2% inflation, and both of those effects will take some time. So setting monetary policy in this environment is going to take careful consideration of the risk to both parts of our dual mandate as the economy evolves. And our dual mandate, of course, is maximum employment and price stability. So recent data showing strong growth and labor market indicators suggest that risks to the employment part of our mandate have diminished. But the recent inflation readings suggest that risks to the inflation part of our mandate have risen. So I'm going to be particularly attuned to the upside risk to inflation. And there are a couple of them. Geopolitical tensions have the potential to further raise oil prices and other commodity prices or to disrupt supply chains. The shortage of housing could keep housing services inflation elevated, even though rents have been falling. Medium and longer term inflation expectations are important determinants of actual inflation, and those expectations have remained reasonably well anchored at levels consistent with our 2% inflation goal throughout the high inflation episode. So that was a benefit because that anchoring was really an important contributor to the disinflation we've seen over time. But if you look at the recent readings, at least on short-term inflation expectations, they've moved up again as the inflation readings have moved up. And if that increase in short-term expectation were to spread to medium and longer-term expectations, it would be considerably harder to reach our goal of 2%. So setting monetary policy to ensure that those expectations remain well anchored will be very important. So the FOMC's job continues to be to assess the implications of economic and financial developments for the outlook and the risks around the outlook, and given that assessment, to calibrate monetary policy so that inflation returns sustainably to our 2% goal and labor markets remain healthy. Now, the actual path monetary policy takes will depend on how the economy actually evolves. And this is that data dependence that policymakers often refer to. But our current policy stance puts us in a really good position for managing the risks that could be realized. In my view, moving rates down too soon or too quickly without sufficient evidence to give us confidence that inflation is on a sustainable and timely path back to 2%, would risk undoing the progress we have made on inflation. And with labor markets and economic growth both being very solid, we don't need to take that risk. Incoming economic information indicates that it's going to take longer to gain that confidence, so holding our restrictive stance for longer is prudent at this point as we gain clarity about the path of inflation. Now, once the FOMC does gain confidence that inflation is moving sustainably back to 2%, it will be in a position to begin to gradually normalize policy back to a neutral level as the economy returns to price stability and maximum employment. Now, it's not my base case, and I want to emphasize this, it's not my base case, but should developments in inflation and inflation expectations warrant it, policymakers will need to be open to tightening policy further. On the other hand, if the labor market unexpectedly deteriorates, again, not my base case, but in that case, policy could ease sooner and by more than currently anticipated. So monetary policy is really well positioned for risk management as we gather more evidence on how the economy is evolving. So the FOMC remains fully committed to returning inflation to our 2% goal because price stability is critical for the long-run health of the labor market, the overall economy, and the stability of the financial system. And as we've seen since the pandemic, high inflation can badly affect people's lives and their view of the country's economic well-being. So at a recent Business Advisory Council meeting that Steve participated in fact, I think he led this discussion, we discussed the fact that even though the labor market is strong and inflation is down from its peak, many people are not very happy about the economy. And if you look at measures of consumer sentiment and consumer confidence, they're well below their pre-pandemic levels. So I believe dissatisfaction with the economy partly reflects the fact that even though inflation has been coming down and wage gains have been relatively high for some people, prices for many things are still higher than they were before the pandemic, and many people's wages haven't really kept up with inflation. So when inflation persists at levels above our goal of price stability, the price level, that overall price level in the economy, is moving up faster than we'd like, and households and businesses have to pay those higher than desired prices. Now, the good news is that as inflation has been moving down, wages adjusted for inflation, real wages, have begun to move up. And as that disinflation process continues, it's going to help close the gap between the cumulative increases in prices that we've seen over this period and the cumulative increase in wages. So as that gap closes, I think people will then begin to feel that they've made up for lost ground. Now, the other factor I think why people aren't that happy with the economy is that it's much harder to purchase a house than it used to be. So the median price of a home in the US is now almost 50% higher than it was prior to the pandemic. If you look at the 30-year mortgage rate, they're now over 7%. Prior to the pandemic, they were under 4%. And if you look at a recent study of consumers that the New York Fed fielded, they found that renters believe that the probability of their ever owning a house, is now falling to 40%. And that's the lowest level since the question was first asked in 2015. And as everybody in this room knows, owning a house is really an important avenue for building wealth. But many people feel this part of the American dream is out of reach, at least for now. And that's just not a good feeling. So I'm hopeful, though, that the economy will evolve as expected, and as inflation returns to our target, we return to price stability, as economic conditions continue to normalize, and as the labor market remains healthy throughout, then more people will be able to enjoy the benefits of what a strong U.S. economy has to offer. So thank you for listening. That concludes my prepared remarks, and I'm really looking forward to our discussion. Thanks.